This week, the Australian dollar traded between 74 and 75.5 cents, remaining surprisingly resilient despite downbeat local and international developments. Last Saturday's federal election result was too close to call, and we saw the Australian dollar start the week 0.5% lower, on risks of a hung parliament and possible action by rating agencies. Even so, the currency recovered by Monday lunchtime. The actual downgrade to Australia's rating outlook from AAA stable to AAA negative came on Thursday. There was only a brief response in the Aussie. The fall was less than a cent and was erased within a few hours. While a negative outlook technically means a 1 in 3 chance of a downgrade over the next 2 years, S&P's commentary indicated that it was looking at a shorter time frame. It would be monitoring the new government's ability to pass budgetary measures over the next 6 to 12 months. The RBA this week kept rates on hold at 1.75% as widely expected. The board did note caution around the results of the Brexit vote, especially on financial market volatility. However, the impacts on Australia's real economy are still uncertain. Linkages with the UK and Europe, such as through trade, are limited. While the RBA did not signal a clear easing bias, the key policy statement noted that they were awaiting further information, suggesting that inflation remains their key concern, and indicating that the August meeting is live. Westpac's base case remains a rate cut to 1.5% next month, and interest rate markets are pricing in 65% probability of such a move. This week, we also saw Australian May retail sales and trade data. Both were disappointing. Elsewhere, the FOMC minutes indicated that many Fed members were reluctant to change their forecasts based on one jobs report, but noted that weak employment data increased uncertainty. Market pricing for Fed hikes, however, remains low, with only a 50% chance of a single hike by December 2017. These releases, however, were overshadowed by other international developments and global risk sentiment. Brexit risks continue to affect markets, and we saw several UK property trusts halt redemptions. There were also signs of stress in the Italian banking system, revealed by volatility following the UK referendum. Political contagion risks also increased, Hungary announcing it would hold a referendum on EU migration quotas in October, joining Austrian elections and the Italian Senate referendum in the same month. October will be fraught with European risks. Reaction in currency markets, however, was mostly contained to the pound. Sterling made fresh 31-year lows, trading down to 128. Waves of risk aversion over the week did also help gold rise to highs since March 2014. Government bond yields across the globe fell to record lows, partly on demand for haven assets and partly on expectations of looser monetary policy for longer. Eye-catchingly, 50-year Swiss government bond yields fell into the negative. In the week ahead, we have an update on Australian business and consumer confidence, as well as on employment numbers. We expect jobs to gain by a modest 12,000, which would be enough to keep the unemployment rate flat at 5.7%. It seems only a matter of time before all the negative factors catch up with the Australian dollar. One potential catalyst is increased concern around China's economy or its currency. Until then, flows should continue to remain supportive, given Australia's relatively high yields, as we have seen recently. So over the next week, we should see the Australian dollar trade within a 73 to 76 cent range. We'll speak to you next week.